When people hear about options trading, the response is usually, that sounds way too risky for me. And that's really simply due to lack of knowledge, because once they understand some options basics and how to trade them, people start to become a little less risk adverse in their thinking. It's clear that options are one of the most misunderstood trading instruments out there today. And those that do understand them, they become one of their favorite approaches to the markets, even beating out futures trading due to the outstanding returns that they can bring. If applied correctly, options can be a very efficient vehicle to trade. Combine the power of options with the NetPicks Options Fast Track program, and you really have a match made in heaven. In order to trade options successfully, it's really important to first understand some options basics and some definitions. So let's start by defining an option. An option is a contract that gives the right to buy or sell a particular security at a given price for a predetermined amount of time. The given price is known as the strike price, and the options are good until the stated expiration date. We're going to use stock options in these examples, so one option controls 100 shares of that particular stock. If a call option is quoted for $2.50, the price of buying this single option would be $250 plus your commissions. Number one, a call option buyer pays a premium for the right, but not the obligation to buy a particular stock at the strike price prior to expiration. Number two, the option seller collects the premium and is obligated to sell the particular stock at the strike price if called upon before expiration. For example, with Apple stock trading at $125 at the end of April, the May 120 call gives the holder the right to buy Apple stock at $120 anytime before May expiration, which is the third Friday of the expiration month. The seller of this option is obligated, if called upon, to deliver 100 shares of Apple stock for $120 per share to the holder of the 120 call. Number one, a put option buyer pays a premium for the right, but not the obligation to sell a particular stock at the strike price prior to expiration. Number two, the put option seller collects the premium and is obligated to sell the particular stock at the strike price if called upon before expiration. So let's look again at Apple and look at the trade using puts. With Apple stock at $125, the May $130 put gives the holder the right to sell 100 shares of Apple stock for $130 per share anytime before the May expiration. The seller of this put option is obligated, if called upon, to buy 100 shares of Apple stock at $130 from the owner of the put option. So what's an option premium? The premium is made up of intrinsic value and time value, known as extrinsic value. The intrinsic value is the in-the-money amount of the option. Number two, time value is the portion of the premium that is over and above its intrinsic value. The in-the-money amount is the amount that the stock exceeds the strike price of a call option, and for a put, the difference between the strike price and the current price of the stock. In our Apple example from earlier, with the stock at $125, the 120 call option would be $5 in the money. An option is in the money when it has intrinsic value. An option is out of the money when it does not have intrinsic value. An option is at the money when the stock price is at the strike price. Now, option prices are greatly affected by volatility. The more a stock moves, the more expensive the options will be. And at such times of higher volatility, options prices can be inflated. If you buy an option at a time of high volatility and volatility drops, the price of the option will drop as well. And there can be times where the stock will move in your direction and the drop in volatility will cause you to still lose money. So it's really important to be aware of the levels of volatility of the options that you're trading. Trading options, as taught in our Fast Track program at NetPicks, where we go further than option basics, can be very profitable, but it's important to understand these basics before diving in. You can build on this foundation to cover how we use these options basics by visiting our options trading tutorials page, and you can view articles from beginning options trading to more advanced topics. When using options, one needs to be right on both the direction of the stock move as well as in the amount of time it takes for the stock to make this move. Option selection is critical when using them in place of the actual stock. Before you dive into options trading, it's really important to grasp some of these basic concepts so you'll be able to put the odds in your favor. And you can get your free options trading system with software, training, trade plans right here.